The Federal Reserve Bank just cut interest rates for the first time in 2025 and markets loved it. We saw markets break a brand new record high, and now the Federal Reserve Bank is even hinting that we might see more interest rate cuts before the year ends. Now, I'm making this video one day late because I wanted to see what markets would do after we saw the Federal Reserve Bank cut interest rates. And what I want you to understand is there's a lot more to these interest rate cuts than just getting a potential cheaper mortgage or a cheaper car loan, because it is going to have direct impacts on our economy and our money, which I want to break down in this video. So whether you have a mortgage, a car loan, credit card debt, or you're thinking about getting a loan, you want to pay attention here. So the central bank, or Federal Reserve Bank, is in charge of our monetary system. That means they have the ability to control interest rates and they have the ability to print money. And the Federal Reserve Bank has what's called a dual mandate. And that's just a fancy way of saying they have two goals that they want to meet. Number one, they want to see maximum employment, meaning a strong economy. And number two, they want to see price stability, meaning low inflation. And up until very recently, the Federal Reserve Bank had been very against cutting interest rates. Why? Because they said they were concerned about tariffs and how tariffs were going to make inflation worse. They were concerned about the economy and the job market, and they said that we don't see a need to cut interest rates right now. Well, now those things have flipped because of three reasons. Number one, bad job numbers. Number two, less uncertainty from tariffs. And number three, stable spending numbers. So let me break this down, starting with the bad job numbers. Not only did we find out that in August, the United States economy added less jobs than expected, but the Bureau of Labor Statistics revised the previous month's job numbers, saying that pretty much for most of 2025, the job market was a lot worse than originally expected. And a lot of people have been talking about the job market not being very strong and being very difficult to find a good job. Well, now the numbers are starting to show that the United States job market isn't growing the way that a lot of people had originally thought. That was the first reason that the Federal Reserve Bank said maybe we need to cut interest rates. Number two had to do with tariffs. Now, for the first half of 2025, Jerome Powell and the Federal Reserve Bank kept saying that we don't want to cut interest rates because we're concerned. Why are we concerned? Because we don't know how tariffs are going to impact the economy. We don't know how tariffs are going to cause inflation. We don't know what tariffs are going to do to the prices of things. And because of that, the Federal Reserve Bank said we don't want to cut interest rates. Well, now that the United States has a lot more tariff deals signed, Jerome Powell says we feel more comfortable starting to cut interest rates because we don't think that we're going to accelerate inflation. And then number three is stable spending. Despite the concerns about inflation, despite the concerns about tariffs, despite the concerns about the job market, spending has still been strong in the United States. And I want you to remember this, because this is going to tie into how lower interest rates can contribute to spending and change our economy and impact our dollar as well, because our entire economic system runs on spending. The more money you spend, the more money somebody else makes. If you walk into Chipotle and you buy the extra guac, Chipotle makes more money, the investors in Chipotle get richer. But if you walk into Chipotle and you say this is too expensive, and you walk out and you don't spend any money, it's good because you keep money in your pocket, but that's bad for Chipotle and that's bad for the Chipotle investors. And ultimately, the largest spender in the United States economy is not you, me, Jeff Bezos, or Tesla. It is the United States government. So now let's talk about how these lower interest rates are going to impact the economy and how they can impact the dollar. And this is where I do want to remind you that if you are an investor or want to become an investor, I'll put together a free investing masterclass where I'll walk you through how you can find hidden investment opportunities before the crowd, and I'll show you the exact system that my firm and I use to research investment opportunities before they hit the mainstream. So if you want to watch this masterclass for free, all you have to do is register by clicking the link down in the description below. And when you sign up for the masterclass, you're also going to get market briefs, which is my newsletter for investors, completely free as a complimentary bonus. So I have that link for you down in the description. So let's talk about how interest rates play an impact in the economy, because what most people think is lower interest rates are going to mean a lower mortgage rate, which means more people are going to buy houses, which is going to stimulate spending, which is going to stimulate the economy, which isn't exactly wrong, but that is missing the key point. Remember what I said just a minute ago. The largest spender in our economy is the United States government. Well, the largest borrower in the world is also the United States government. The United States government has $37 trillion of debt. And on top of that, the United States government is expected to spend around $2 trillion in 2025 that they do not have, meaning they're going to be borrowing this $2 trillion. But the question is, where do they borrow this money from? They can borrow this money from people like you and me. They can borrow this money from foreign countries, but that's not enough to actually lend money to the United States government. And that's where the United States government will then also borrow money from the Federal Reserve Bank. Now again, the Federal Reserve Bank is our central bank, but they're actually not a bank because you and I can't go there to deposit money. They're actually not a reserve because they're not sitting on any cash reserves, and they're actually not federal. They're not a part of the United States government. It even says so on the website that they're not federal. So when the Federal Reserve Bank has to lend money to the United States, how do they do that? Well, they print that money. They create this money out of thin air and lend it to the United States government. Now, let's play through the scenario. As interest rates go down, what do most people do? If you have a 7% mortgage and now mortgage rates fall to, let's just say, 5%, what do many people do? They refinance. And when you refinance, in theory, you would have a cheaper mortgage. Well, that works assuming that you don't take on any more debt. But what happens if your home goes up in value? So now you pull out more cash, and now because you're pulling out more cash, your mortgage payment might not actually drop. It might stay the same, it might go down, it might go up depending on how much more cash you pull out. Well, in the United States government's case, they have all this debt, and the fastest growing expense for the United States government is interest. And there's a couple reasons why. Number one is because we've accumulated so much debt. And number two is because the interest rate on that debt has gone up so much since 2020 when interest rates were at 0%. So now the United States government has all these interest expenses that they have to pay, and they're paying this interest through our tax dollars. And this is where the United States government, as interest rates go down, they will likely want to refinance their debt so they have lower interest payments, but that also allows them to go out and borrow more money. Why? Because they want to continue spending, because as the United States government spends more money, well, that stimulates the economy. Why? Because if the United States government funds a construction project, they fund a technology project, they fund a healthcare project, they fund a welfare service, all of this money goes into the hands of businesses or people, which then stimulate the economy, creates jobs, and does all of that other stuff. But there's a consequence. What is the consequence? Well, of course, the consequence can be inflation. If money has to be created out of thin air, because our money, what we call money, isn't backed by physical gold, it's not backed by silver, it's not backed by precious metal, it's backed by a promise that these dollars have value. That's why these lower interest rates matter, and that's the first reason how we could potentially create inflation depending on what actions the United States government does. Because we know that President Trump has been wanting lower interest rates. He's been demanding 1% interest rates. And there's, again, two reasons because of that. The reason number one is lower interest rates mean you can buy a house for a cheaper mortgage. Reason number two is the United States government can then refinance their debt and pay less money in interest, or they can go out and borrow more dollars. That way they can stimulate the economy. And the United States government has been looking for ways to continue stimulating and boosting the economy where we are right now. But then it also impacts people, the lower interest rates, because as interest rates go down, it gives more breathing room for banks to cut interest rates as well. Now, lower interest rates by the Federal Reserve Bank don't directly cause lower mortgage rates. They don't directly cause lower credit card rates. They don't directly cause lower auto loan rates, because these interest rates set by the Federal Reserve Bank impact how much banks charge each other when they lend each other money. The actual retail rate, your mortgage rate, your credit card rate, your car loan rate, that's set by the bank, and there are other economic factors that are going to determine how much you pay when you borrow money. But interest rates can have an impact on that. So as the Federal Reserve Bank cuts interest rates, that then creates the ability for banks to also charge you less money when you go out and you get a mortgage. Well, why does that matter? Because we're already in one of the most unaffordable housing markets of all time. Cars have become very difficult to purchase because they've become so expensive. And the reason why these things have become so unaffordable is because, number one, the prices of cars and houses have gone up so much, but also because the interest rate that you have to pay when you borrow money on a car or a house has gone up as well. Now, I don't recommend you go out and buy a car with debt, but most people are going to buy a house with debt. And when you have house prices that have gone up by 50% over the last 5 years, and you have mortgage rates that have gone from 3% to 7% over the last 5 years, you can start to see why we have one of the most unaffordable housing markets of all time. And this is where a lot of people are getting excited that these lower interest rates are going to cause lower mortgage rates, which is going to cause people to, number one, buy more houses, which could cause house prices to go up again, but that could also cause a boom in refinancing. What does that mean? If home prices stay high and your mortgage rate goes down, well, a lot of people will now have equity in their houses. And if you have equity in your house, you can then refinance your mortgage. Now, let's assume you don't pull out any cash. If you could refinance your mortgage from 6.5% or 7% to 5%, well, now you can save money on your monthly payments through that. And some people, in fact, many people will then use it as an opportunity to pull cash out of their house equity. That way they can spend that money and maybe they'll have a lower mortgage payment because interest payments have fallen. But that refinance, cash out refinance can then stimulate the economy as well, because now people have more cash in their hand, not cash that's sitting in the value of their house in this invisible equity. They have cash in their hand that they can go and spend at Home Depot. That way they can buy things to do a renovation. They can take that cash and go on a vacation. Now, again, I'm not saying you should do this. I'm saying this is how the economy looks at it. This is why so many people on Wall Street are getting excited, because now the Federal Reserve Bank has finally started cutting interest rates in 2025. They cut interest rates in 2024, but then they put it on a complete pause because of the uncertainty of the job market and tariffs and spending. But now the Federal Reserve Bank has started that interest rate cutting process again, although it was not a big interest rate cut, but they're also hinting at cutting interest rates again in 2025. And on top of that, President Trump wants to see more aggressive interest rate cuts in 2026. What do I mean? Well, Jerome Powell, who again is a chairman at the Federal Reserve Bank, he is probably going to retire in 2026. Why? Because his term ends in 2026, and President Trump has made it very clear that he does not like Jerome Powell, and he will very likely replace him with somebody who is much more gung-ho on wanting to cut interest rates. So if that happens in 2026, then we can start to see more aggressive interest rate cuts in 2026, which means, well, cheaper debt, higher valuations, more dollars flowing in our economy, more potential money printing, which could make the inflation problem worse, but it makes the financially savvy richer, and unfortunately, it makes everybody else poorer. Why? Because inflation hurts the average person. Inflation makes the wealthy wealthier. It makes everybody else poorer, because inflation makes consumption more expensive. Everybody is a consumer. Rich people, middle class people, poor people, everybody is a consumer because it costs money to eat. You go to the store, you're a consumer. You buy clothes, you're a consumer. You drive a car, you're a consumer. But inflation, that same inflation, also makes investors richer. Why? Because when more dollars enter our economy, those dollars flow into the hands of investors. Our entire economic system is designed for dollars to flow into the hands of investors. And when you understand that, you're going to use your money very differently, but that's how our economy works. You go to Chipotle and you spend money. Who is the winner? It's the owners of Chipotle. Who are the owners of Chipotle? It's the investors in Chipotle. You go to Amazon and you buy something. Who does that benefit? It benefits the owners of Amazon. Who are the owners of Amazon? It is the investors in Amazon. It is the business owners that win. Now, the nice thing about this system is you don't have to go out and create a business to take advantage of this. You can just push a few buttons and own the business. Now, I'm not saying you need to go out and buy Amazon or buy whatever company. I'm saying you need to be an investor. That way you can win in this system. Yes, markets go up. Yes, markets go down. But there are ways, once you know your investing strategy, to mitigate your risk. That way you can build your wealth over the long term, because the reality is this economy is going to continue to make the financially savvy wealthier. And the average person is not going to understand why they keep getting left behind. People keep saying that they need lower interest rates so they can buy a house. Well, in reality, lower interest rates are not going to make it easier for you to build wealth if you are not financially smart. Lower interest rates make the financially savvy richer. And, well, for everybody else, if there's more inflation, it makes things more expensive and it makes things more difficult. Not to mention the fact that if you have money in a high-yield savings account, lower interest rates also mean that the interest rate that you earn on your high-yield savings account also goes down. So I hope you got a value out of this video. Again, you can watch my investing masterclass. I have the link for you down in the description. And if you enjoyed this video, the best thank you is to share this video with a friend, a family member, a colleague, or a fellow investor. And with that, I'll see you on YouTube on Monday.